Bloomberg Audio Studios. Podcasts, radio, news.
Hello and welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, we are here in Jackson Hole for the Economic Symposium held by the Kansas City Fed, every year. And every year they choose a theme for the conference. So last year, I think it was structural shifts in the global economy, something fairly generic, actually. Yeah. This year, it is all about the transmission of monetary policy.
That's right. And there's some pretty big questions. So it's like we all have this idea that you slow the economy or you fight inflation by hiking interest rates, and then you lower interest rates if you want to stimulate things. But how does that actually work? And this cycle has raised a lot of questions in particular because things that you might have expected to see, such as a sharp rise in the unemployment rate amid the fall in the rate of inflation, hasn't really happened. So I think there's a lot of ambiguity still about what is the process via which monetary policy, which is both interest rate policy and I guess balance sheet policy, what is the process through which these decisions actually transmit to the real economy? Right.
And we're going back to the debate that was popular maybe a year or two ago, which was if you have major disruptions in the economy, like with shipping or whatever, and prices increase because of that, is increasing interest rates actually going to do anything about those particular constraints? But then just beyond those discussions, which we've been having for a long time and we now seem to be having in reverse, there are also a lot of things that central banks have done over the past couple of years that are unusual in one way or another. I think today we probably, 2020 was 4 years ago now, and so we've learned to live with them. But if you think back, for instance, to the Fed's Treasury program in March of 2020, right? That was a big deal. And they rolled it out really quickly.
And they also bought a bunch of types of assets or entered into a number of markets. I mean, they,
corporate bonds.
Yeah, corporate bonds. So other markets through which the Fed has almost never touched in the past. The other thing that's worth noting here in the preface to this conversation is that for the vast majority of people that are even vaguely aware of this thing called Jackson Hole, it's to the extent that Chairman Jerome Powell gives a speech, but it is an academic economic conference and there are a number of papers and presented. There is more here than just one speech from one guy.
No, absolutely. There is a series of presentations and papers that are presented. And I am very happy to say that today we are going to be digging into this question of transmission of monetary policy. And we are going to be speaking with one of the panelists from the event. And he's going to give us a sort of inside look at how all of this works. And
what
also,
they're talking about.
Yeah. So I am very excited. We have the perfect guest. We are speaking with Anil Kashyap. He is a professor of economics and finance at the Chicago Booth School. That's a very ominous.
Yeah, thunder in the middle. That's all right. We can keep that in the recording.
Sound effect. There's a mountain storm rolling in right now. Anil, thank you so much for coming on All Thoughts.
Thank you. Mother Nature's going to supply liquidity.
It seems like it. Okay, so how does this work? How is it that you come to be at Jackson Hole and you are asked to give a presentation on, you were on the transmission of monetary policy panel, but the particular angle that you were taking or the paper you were presenting was monetary policy implications of market maker of last resort operations. So how does that come to be as a sort of subject, a topic for discussion?
Well, they start trying to put the program together sometime around January, and they contact a bunch of people saying, this year the theme's going to be X. You've written on some issue adjacent to X. Would you be interested in preparing a paper? So first thing that has to happen is they got to ask you, but you also have to have enough room in your schedule to actually produce something. Now, I was on a panel, and the panel was about the linkages between the financial system and monetary policy transmission. So that was our little bit of it. There were two other papers today about government debt markets and also about the Phillips curve. And so the conference surrounds the topic of monetary policy transmission through a bunch of cumulative papers that are written by different people. And then each paper has a discussant. The discussant's usually also written on the topic. So in our case, I got a call just saying, you've done a lot on financial stability and monetary policies are something you would be willing to talk about. And I said, sure.
So when we think of monetary policy, we think of interest rates, or we think of other tools besides moving up and down rates that affect interest rates. So forward guidance can be a type of interest rate policy. QE, in a sense, can be that as well. During March 2020, when the market basically broke, the Fed intervened massively to stabilize the Treasury market in a way that maybe mathematically, in some sense, looks like QE, but it was not QE in the way that QE was done, like during the Great Financial Crisis, because it wasn't about rate guidance, so that came somewhat separate. But it still was balance sheet operations in order to stabilize this. Talk a little bit more basically about what your contribution to the panel was about.
Well, I pointed out that the Fed's process and explanation for what they're doing kind of evolved pretty quickly. So if you go back and look at what they said on March 15th of 2020, they said, we've got to stabilize the markets. This is a financial stability intervention. We're going to buy this stuff because we think that there are kind of plumbing issues in the financial system that are messing up the U.S. Treasury market, and that market's the foundation of everything. By a week later, at their next unscheduled meeting, they said, and this is also going to support monetary policy. By April, now we're 6 weeks later, they've got monetary policy and market functioning side by side completely there. And then by the time you get to September, they've dropped the financial stability rationale. Now they're talking about a monetary policy operation, by coincidence, buying exactly the same amount of bonds. So what I said is, it worked out and it was certainly appropriate. I think there are at least some people in the Fed system that will say, we carried on then for another 18 months buying this stuff. And looking back, do we wish we'd stopped sooner? Maybe. So that was the entry into this discussion.
Yeah, Tracy, I remember at the time feeling as though the Fed had sort of backdoored itself into QE, starting with this big asset purchase for pure plumbing reasons, but then finding it hard to extricate in the same way that the original QE was, in a sense.
Well, also the mission creep from the plumbing of the U.S. Treasury market, which I think we all agree is very important for the overall global markets and also the economy. But then they started buying corporate bonds as well, which was a huge step change.
Yeah.
I remember in the sort of early to mid 2010s, because I was covering the corporate bond market at the FT. And I remember every once in a while, I would say people say that if this market blows up, the Fed might have to step in and buy corporate bonds. And this was a big deal. And then fast forward to 2020 and it happens. And there was so much else going on that it didn't get as much attention as it should have, in my opinion. But Anil, the corporate bond purchase program, what did you think about that and how that fit into?
Well, that actually, they did buy that stuff, but then they got rid of it pretty quickly. So there's a little bit of a distinction between what happened there and what happened with the treasuries, where it kept going. So they kept buying the MBS and treasuries for much, much longer. And what my paper was about was to contrast what happened there with what happened in the fall of 2022 in the UK. Disclosure, I was on the Financial Policy Committee of the Bank of England at that time. So for the beginning of that, at least, I had some firsthand experience there, but I'm not speaking for the Bank of England here. And that program was conducted very quickly. There was 13 days over which they bought, and they actually, the thing people tend not to know is that they sold it all in 12 days. So they really got in and got out.
Oh, yeah.
And they managed to pull that off when they were buying for the financial stability rationale. At the same time, they were starting their QT. So here you've got these two things. Wait, you're buying, you're selling, which way do you want to have it? But they managed to pull it off pretty gracefully. And so what I was trying to suggest for the Fed is maybe they should look at their institutional structure and see if they want to do a little bit of tinkering so that they would have some sort of advisory group that would make the financial stability call that isn't exactly the same people as doing monetary policy.
That's super interesting. I had forgotten that point, how quickly, because I remember when the Bank of England stepped into the market and people were like, oh, they've backtracked, they've lost their heart, they're not going to do it. But actually, they really had continued the fight against inflation, and that ended fairly quickly. Say more about, from the Fed institutional perspective, why the Fed has found it challenging, or did find it challenging in 2020, to sort of de-link asset purchases for the purpose of smoothing a market versus asset purchases for the purpose of conducting monetary policy.
Well, so to be fair to them, I got asked this question in the discussion. Somebody said, well, what difference does it make? They bought the stuff. It was clear they were going to need to buy much more. So you labeled it financial stability. Imagine that they'd stopped in April and then the FOMC a month later said, now we're going to start buying and we're going to buy the same amount. Do you really think it would be that different? Maybe in that particular outcome, it wouldn't have been so different. But my point is more like you never know when the next plumbing problem is going to show up and what the circumstances are. And I think you would like the market to believe that if you do face a Bank of England situation, that you've got, a recipe for dealing with it and that you've thought it through and people can kind of understand the way it's going to work. And to me, if it's the exact same group of people who make all the same decisions and you want to call this is a financial stability, that's a monetary policy decision, I think it just muddles the communications. And it also, I think for the financial stability decisions, there are experts in the Federal Reserve System that you might want to consult and actually give them a voice. Now, the way the Fed works, the FOMC owns every decision about the Fed's balance sheet. So I recommended this Purchase Facility Committee, a PFC, and I don't think the PFC could legally order the Fed to do anything. They could make a recommendation and the FOMC could then ratify. But I still think there would be some benefits to saying, well, our technical plumbing committee, is looked at this, decided that there's a problem and said, why don't you go ahead and act on this recommendation? And then presumably then the PFC would a few months later say, we think this is done. You could end it and you can go ahead and start selling. And ideally you would have announced the rules under which you would sell. How are you going to determine how much you're going to sell? Who are you going to sell to? All these kinds of things. But there's a bunch of technical issues that need to get worked out. And again, if you want to convince everybody this is separate, then having a whole separate playbook that you point to, I think would be valuable.
I have a Jackson Hole related question on this, but you mentioned that someone asked you a similar question at the event.
Yeah.
What's reception like at these things? How do you know if your presentation has been successful? Because something like your paper, you're making constructive criticisms of a program, but they are, to some extent, criticisms nonetheless. So what do people say after you present?
Well, most of the people that are in that room know each other. I've known a lot of these people for a long time. Some of them will tell you they think you're full of it. They'll just say, you didn't convince me at all. Had somebody tell me that just 15 minutes ago. But there are others that said, hey, that's pretty good. I'd like to think about that more. Let's stay in touch, kind of thing. So you're never going to get unanimity in a group that diverse. And I think you figure out if what you were arguing in favor of actually changes what they do. So if they bother to set up a PFC or some other central bank does, I think that would be fantastic. And I think it could happen.
You mentioned the Bank of England episode in 2022. Similar questions arose in March 2023 when SVB blew up. Yep. And there was once again these questions, will the Fed have to do something that at least on surface is in contravention of the ongoing fight then against inflation? I'm actually curious, this distinction between asset purchases for the conduct of monetary policy versus asset purchases for the conduct of market stabilization. I would actually be curious your story of what does asset purchases for monetary policy do? How does that transmit? How does QE transmit?
Okay, so can I do it in two steps? So
Please.
Let me first say, asset purchases for financial stability should only be deployed when a lending facility won't work. Going back to Badgett, everybody understands central banks lend, and all of that. So the thing that's weird about asset purchases is you're finally admitting, okay, the lending facility isn't enough. In March of 2023, the lending facility worked. They didn't actually have to buy anything, so it's a little different. And I think making that distinction, it's true your balance sheet grows for a little bit when you do the lending, but I still think it's worth for analytic clarity to separate those two. How does QE work? Well, you could have 5 conferences on that. So the Fed's theory of this has always been that you take duration. You're buying longer term securities. You're taking that out of the market. There's people that crave duration that want to have that in their portfolio. And so the first thing you do is you reduce the supply that's available to market. That lowers interest rates to some extent, but it also probably changes term premia because people have to now pay a premium if they want to get the treasuries that you've taken away. They're going to bid that up. And then if they want a duration, they're going to go find it somewhere else so that they think that that's going to spill over into adjacent markets. It's incredibly contentious as to how wide the spillovers are. We know the best evidence for QE comes when markets were very dysfunctional, and whether this was just a signaling thing that the Fed's got your back, or whether it was really this complicated theory I just gave you is very hard to know. But I guess that's the state of play.
Joe, do you remember that Ben Bernanke quote where it was like the problem with QE is that it works like in practice but not in theory or
it's
something?
a great line.
Yeah. Okay, well, on that note, maybe we can broaden this out a little bit and talk about the transmission of monetary policy in general. But it feels like a lot of the debates that we had post-2020 are now potentially happening in reverse, where we're asking like, okay, the Fed's going to ease. What does that actually mean for the economy and for markets? How are you thinking about that?
Okay, I think that question's related to the thing that the two of you talked about at the beginning, which is, okay, the Fed's going to hammer the economy. They've raised rates, 500 basis points. The economy has not fallen into recession and crashed. So part of the motivation for the conference is, how did that happen?
Yeah.
And now inflation is starting to come down. How did that happen without slack opening up nearly so much?
How did it happen?
I think we don't know. Part of it is the stuff that we didn't understand or see coming on the way up has certainly reversed itself. So some of it they got maybe for free. Some of it is people are not still asking for aggressive wage increases. So we haven't seen these second round effects where because you discover your grocery bill's higher, you go to your boss and say, I need a raise. And then he gives you a raise and he has to raise his prices and so on. So we haven't had a huge wage price spiral. So that's been helpful. Chairman Powell today talked about inflation expectations being anchored. And because people kind of trust the Fed, they're content to go back for asking for normal raises because they think prices are going to grow at the normal rate. So I think it's a complicated story. On the question of why didn't the economy tip over, I think that's a very other contentious debate. Some of it looks like the fiscal stimulus was bigger and more targeted in ways that impacted monetary policy. So what do I mean by that? Well, number one, auto industry normally gets crushed when the Fed hikes interest rates 500 basis points. People still can't get cars from the shortages from 4 years ago. So the auto market hasn't tipped over quite so much. Construction normally gets crushed. Well, the Inflation Reduction Act, aptly named, has generated all kinds of construction spending. So that hasn't tipped over. So those are two of the engines that normally tightening would work through that haven't been crushed. Now, the housing market has been hurt some, but I think it is very much an open question as to how they've pulled this off.
What does it say that there's so many open questions? Like, we're like, okay,
it's a good time to be an economist.
We could have 5 conferences on how QE works alone. We don't really know the degree to which interest rate hikes have depressed inflation versus some of the reversal of these distinct factors. Like, big picture, the fact that like so much energy is spent in markets and everyone else thinking about monetary policy, and yet these core fundamental questions are like massively open for debate. Like, what's your take on that?
I think we got lulled into a sense of false security by 25 years of pretty good luck, where we didn't have big shocks and where central banks built a theory of the case of this is how the economy works. We know we can fine tune and land things just right. We need to worry about these 1 or 2 variables. We've got this kind of conventional consensus. And, that kind of got blown up in the global financial crisis where the simple models, the Phillips curve and all that didn't work out so much because if you saw the size of that recession, you should have had massive disinflation. It didn't happen there. Then we didn't see this inflation spike coming. It came. Now it's dissipated. Again, no recession. So I think part of it is the period between about 1984 and now has been an anomalous period. We didn't have deep recessions. We didn't have these wild external shocks to deal with. And I think that also means that it's really hard to do empirical work because there's not a lot of variance. And so there's lots of theories that work just about as well. Like, I think inflation is going to be what it was last year. That model's incredibly hard to beat.
Speaking of empirical research, I wanted to ask you about one of your, I think probably one of your most well-known research projects or papers, and this was on price setting during your PhD. Joe asked you how QE works, so I'm going to ask a very simple question, and then hopefully you can talk about your paper. But what changes prices, or why do prices change?
Well, businesses will try to pass through cost shocks when they come. But for lots of goods, the costs just keep falling because automation and just supply chain efficiencies keep getting ever greater. If you just look at the way that prices for so many goods have evolved, the costs just keep falling. And so we haven't had a great amount of cost pressure, at least for goods. Now, for services, it's rather different. And you certainly saw after the pandemic, if you tried to go on vacation or come to any place where you could go hiking and be away from people, it got really expensive and the market cleared by price, just like you got taught in your Econ 101 class. So I think it depends on what you're looking at. I think for the service sector, the usual story is kind of right. It's demand versus supply. And if demand surges, prices are going to go up. In many cases, what you actually see, like in supermarkets, is you just see fewer discounts. So there's a lot of loss leaders to draw people into the stores. When the economy's running really hot, they do less of that. So that's a hidden price increase, but the effective price paid is going to go up.
It occurs to me, you're talking about this like long stretch of stability, or people talk about it, the great moderation, and this confidence that like central banks, or maybe just the Fed in particular, has this power to sort of solve any problem or smooth over any problem. And then there was a lot of questions about whether that was true during the great financial crisis. But then the economy, maybe not as fast as we'd like, but slowly resumed its ascent. Then COVID comes and we get a very different kind of shock, an inflationary shock. But here we are in August 2024. Unemployment is below 4.5%. Inflation seems to be back to target, basically. Like, I feel like you could tell a story in which all of the belief about the omnipotence of the Fed actually kind of keeps getting vindicated.
Yes and no. I mean, I think that they showed tremendous courage hiking interest rates as fast as they did. One of the other panelists on my panel was talking about communications policy and pointing out how much more predictable Fed policy has been, which I thought was quite interesting to show just how systematic it is. And it's not just the Fed. All the central banks have gotten away from this. We got to surprise them,
Oh, yeah.
There's
I forgot about that.
Think about Greenspan. I used to give a handout to my class of a 1991 FOMC meeting where he talked about the journalists are going to be watching you at Jackson Hole, the tilt of your head, which way you look and how you answer a question. We can't let them know what we're thinking. So
God,
now
like
it used to be like that. Yeah,
they used to prize their ability to surprise.
Yeah.
I forgot about
so
that.
They've done a lot of good stuff. And if you looked in December, somebody raised this at the meeting, in December of 2021, if you asked how much higher interest rates were forecast to be, I think at the end of 2022, it was something like 75 basis points. Well, they blew through that. So even they didn't know what they were going to do. But once they got going, giddy up.
So the panel where you were speaking, it was about, the financial stability and the transmission of monetary policy. And we are coming off of quite a dramatic market event. So we're speaking on August 23rd. And then, a couple weeks ago, we had this huge sell-off in markets, lots of talk about the unwind of the carry trade. And at that particular moment in time, there were some calls, or maybe at least one call, for the Fed to do some sort of emergency intervention. Given your knowledge of financial stability and your work on this topic, how did you view that episode? And what's your sense of the response that the central bank should have taken, if any?
Well, look, the markets always want to get bailed out. So the fact that people were saying that this should happen is no surprise. But I used that as an example in my talk. I said, it turned out in the event that there was not so much instability at the beginning of the month as to have any central bank have to go intervene. But if they had intervened, I think they would have wanted to use the Bank of England playbook. And they would have wanted to say, this is just like what the Bank of England did. And so the spirit of my comments were, okay, not everybody has the legal infrastructure that the BOE does. So there is a financial policy committee. It's by statute. There's all these rules around it. If you don't have that, why don't you go ahead and set up something that would approximate it? So let's suppose the thing in August had gotten much worse and had gone on for a few more days into a week or two, and then somebody was going to buy. What would they have said about it? And I think they're having the playbook worked out and agreed amongst yourselves in advance and communicated to markets probably would make that easier next time around.
Yeah, I remember this was potentially one of the differentiating factors of March 2020 was that the Fed kind of had a playbook of what it could potentially do. And so it could kind of pull it off the shelf. I have just one more question, which is looking over your career history and your research, it is incredibly varied. Probably like one of the most varied academic careers that I've seen. So you've done work on Japan's economy. I think maybe you came up with the term zombie firms, or at least you did some of the early work on that topic. You did early work on contingent capital, COCOs, living wills. Like, how do you decide what you want to look at and examine, and what do you think you're going to be looking at next?
Well, I mean, one thing kind of leads to another. So I started out, I was on the staff at the board, actually, and Greenspan was talking about stuff in 1990 that I couldn't understand. And my colleague, my longtime co-author, Jeremy Stein, maybe you've had him on here, Jeremy and I were talking, and we started trying to figure out, like, how do we understand what he's talking about? So we started studying banks, how monetary policy transmission worked through the banking system. Then we started learning about banks and started thinking about financial regulation because it's kind of tied up. And Japan had this really terrible productivity, 10-year-long crisis where the banks were in the middle of that. So a lot of this is all tied together by banks. Actually, the next thing I'm working on is actually money laundering.
Oh.
So imagine you think about where the global economy is going to be in 5 or 10 years. My guess is there's going to be more fragmentation. There'll be a lot of stuff on sanctions. There's going to be friendshoring. There's going to be all these forces. And that kind of economic policy involves the state compelling the private sector to do stuff that it wouldn't otherwise do. Okay. When you think about most regulation that the government engages in, it's to correct an externality. It's some adverse spillover, private incentives don't align. This isn't that. This is like, okay, we think there's a risk of another 9/11. We're going to compel you to do a bunch of stuff. It might cost you $500 million, but you got to do it. Where do you draw the boundaries on that, and how do you think about it? Well, economists don't have a great way of thinking about problems of that sort because you can't do cost benefit if, you think about the value of a human life. You could try to start adding this stuff up, but it's not very satisfying. It turns out there is one part of the U.S. economy where we've run an experiment. It's a 50-year-old experiment, and it's where we compel the private sector to deal with money laundering. And so if you look at the history of how money laundering laws have evolved, there's a lot of lessons in there for once the state starts compelling the private sector to do stuff. So Kate Judge and I are working on a book on this.
Can you tell us some of the lessons? We'll read the book still, but some of the lessons
Kate come back. There's so many. It's going to be a book. But there are just many, many analogies about, you start out, you don't have an overall set of principles and objectives. So what do? You're reactive. So think about the way we did Russian sanctions. It's kind of pulled out of the air, made up. You look at often there are competing aims with respect to money laundering. So we don't want to push people out of the financial system, but if we make the know your customer stuff too onerous, we drive them out. So there's a trade-off. It's kind of hidden. We don't have a good formula for dealing with. Think about all the things we're going to do with which Chinese companies do we cut off? Where are we going to draw the boundaries? So there's many, many, many analogies.
All right, you're going to have to come back on Odd Lots, or Kate will, to when the book is out, to give us all the lessons and all the detail and nuance. But in the meantime, Anil, thank you so much for coming on Odd Lots. Really appreciate it.
That was fantastic.
Thank you.
Joe, that was interesting. And part of me thinks it's kind of crazy that was the first time we had Anil on.
Yeah, he was great. And I know all these different topics. We didn't even really talk about Japan at all, which
we could have done a whole separate episode just on Japan.
Totally. I really enjoyed that. And I do remember thinking in March 2020 that this massive balance sheet expansion that the Fed engaged in was not the same thing as the QE. Even though in the monetary aggregates, it looks like it's all the same thing on the chart, that there was clearly something different. And I remember thinking like, oh, that's sort of got a tricky situation here, because then they had to figure out the sequence of the unwind, then to the first rate hike. And so it's interesting, and then we sort of forgot about that. It's ancient history. But the idea that there are costs if a market intervention for financial stability purposes ends up intersecting with whatever you're trying to fight on the macro front.
Right, with monetary policy. And then you get those sort of cross currents. The other thing we'll have to watch out for going forward is if there is a PFC created. We'll know where it came from.
Well, because everyone listened to Odd Lots, or either that, or maybe it came from him
Anil
speaking in the room at Jackson Hole. It's got to be one or the other, though. But the intuition there makes a lot of sense. And I didn't forget the whole Bank of England, Liz Truss pound mini crisis in late 2022. But I had forgotten how quickly the Bank of England was able to extricate itself.
Yeah.
And because there were a bunch of, people like, you lost your will and the fight against inflation is there, they do it again. And of course, there was the opening of the discount window activity in March 2023 in the U.S.
It kind of got lost in the political drama that happened afterwards. But
it wasn't. Both of those are examples of how there are certain aspects of the balance sheet that don't inevitably have to interact with the macro fights you're trying to have.
Right. Like you can design these sort of last resort programs to fine tune certain aspects of financial markets.
Totally. And this is where, if you accept the premise that there is a fundamental difference between asset purchases for financial stability versus asset purchases to drive interest rates lower or take duration out of the market, then this is where the problem of a sort of pure money supply approach comes from. Because, again, on paper, it's all the same M, like M1 or M2, whatever it is. But they do have different functions. And I do think this is where sometimes people get led astray simply by looking at that aggregate chart and not realizing that at different times, those purchases, even though it's still just, reserves for securities, can do different things.
Yeah, I think that's right. All right, shall we leave it there?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me at The Stalwart. Follow our producers, Carmen Rodriguez at Carmen Armand, Dashiell Bennett at Dashbot, and Cale Brooks at Cale Brooks. Thank you to our producer, Moses Andam. For more Odd Lots content, go to Bloomberg.com/oddlots, where we have transcripts, a blog, and a newsletter. And you can chat about all of these topics 24/7 in our Discord, discord.gg/oddlots.
And if you enjoy Odd Lots, if you like it when we bring you inside the room at Jackson Hole, figuratively, of course, then please leave us a positive review on your favorite podcast platform. And remember, if you're a Bloomberg subscriber, you can listen to all of our episodes absolutely ad-free. All you need to do is find the Bloomberg channel on Apple Podcasts and follow the instructions there to connect your Bloomberg account with the platform. Thanks for listening.